Hi, this is Jeffrey Cohen, President and Founder of Chicago Quantum. We're here to talk today about the markets, and I'm going to talk about just a few things. Number one, macroeconomic and monetary policy. Then I'm going to talk about COVID. Not that everyone wants to talk about COVID all the time, but I think there's some new data that's actually pretty important. I think there's a big risk of another shutdown. We talk about three stocks, our biotech stocks, STSA AKBA and CRBP. We're going to talk about becoming an investment advisory firm, what it entails, what it means, and the fact that we are now committed. We made the decision. We are on our way to becoming an investment advisory firm, basically licensed by and certified by the Fed and state of Illinois. We're going to talk about what all this data means for stock market investing. It's an opinion, not advice, but hopefully you'll find it insightful. That's the whole point. There's so much data that it's starting to paint a very clear picture for me, clearer than it's been in a long time. And then finally, I'm going to make the big prediction. Huge prediction. If you do nothing, just go to the end and hear the big prediction. So all the data that we share with you is going to lead to that huge call, which could change your life. So, and also just to point out, this is a Chicago White Sox shirt. This is a Chicago White Sox family. Nobody here is a Cubs fan. Well, actually, my wife is, but she's at work. So, this house, White Sox house. So, let's get started. Oh, look at here. What do we have on our page? We are at the Congressional Budget Office. U.S., of course, U.S. Federal. This year, ending in August 30, we're going to spend $6.8 trillion at the federal level, take in $3.8 trillion, and that leaves us with a deficit, a federal budget deficit of $3 trillion. I want you to think about this a different way. No judgment. That's not what this is about. But just think, when you woke up a year ago and you said, oh, how's the economy doing? It's like a $20 trillion economy. Well, we're going to spend $3 trillion more than we're going to pull out. So this is 15% deficit spending. So if the economy shrunk by 15%, this puts it right back. I just want you to think about that as we go through the rest of it. The backdrop of our economy is that the U.S. federal government is pumping 15% right on in there. Personally, I think this is amazing. So, and just for those who like charts, let's show you what that looks like. I'm going to zoom right in. This is provided by Bipartisan Policy Center. I am not going to validate that it's a good organization, but they have a nice chart. So, in purple, 2021 deficit. So you can see deficit spending pulled away. By February, we had significantly overspent previous deficits, because you could argue that it's just accounting. Don't worry, it's a difference between corporate and government accounting. But really, we've made a pretty big shift. February this year, March, and then we start tightening up relative to last year, which is always interesting, but still pretty loose in regards to normally the last couple months. So we've kind of flattened out. So deficit spending is kind of slowed down. What do you think about that now? So we primed the pump in the economy, 15%. But really most of that 15% was on track to be spent by March. More than half. So and now we're rolling. It's good. So I want to show this to you because we're a little bit of a taper, a fiscal taper. I can almost imagine, I can hear in my mind President Biden and the congressional leaders, Nancy Pelosi, saying, we probably shouldn't spend all the money, because if we're going to have another COVID shutdown, we need more money. So maybe we should slow down a little. That thing where we're going to do an infrastructure spend, maybe we'll push it out a few months. Push it out to October. Maybe we can flatline our deficit. This is just saying that maybe we're gonna take some of the the fire out of our economy. So this was a chart I tweeted earlier this week. I think it's important. I'm probably the only one I know that follows the Federal Reserve this much, right? Who's not like an economist for business. So what this chart says, this is by the Federal Reserve Board, it's the Fed. It says for monetary stock, M2, this is basically your cash, your demand deposits, but also your time deposits, your CDs, your smaller money markets, things like that. So it's money you could get at, let's say, within 30 days, maybe lose a little interest. Flat. This thing hasn't been flat. If I show you the chart, I can go back years, decades. Maybe it was flat a little bit in 1992. Maybe a little flat in August of 2010, but this is not normal. Right there, 2003, we were probably flat for a month. Well, we're flat now. Weird. From May to June. That's not that weird. So what this says is, whatever the economy was doing to pump money into the economy, this is actual money. Like, pull out your wallet, money. Okay? This is actual money being made. Okay? There's no new money this past month. This is a historic occasion, by the way. This is not normal, right? So no money. No money. And we're going to slow down, probably, fiscal stimulus. What else is going on? I'm just saying, no money. I want that to sink in because it's a pretty big deal. Overnight reverse repurchase agreements. Treasury securities sold overnight for money by the banks and then bought back the next day. So a bank has money, wants to earn a little interest. Who doesn't, right? So it gives the money to the Fed to hold on overnight. But how much is it given? Again, let's take a little look at what's normal, right? You could say, Jeff, you're cheating a little bit because you're showing me just a couple months here. Let's go all the way back. Let's go way back. Let's go all the way back. Shit, let's go to like 2004. And what you see is, except for a little peak here, and those numbers, by the way, if you can't read it, probably averaging about 150 billion. Then all of a sudden you got a little spike there. Oh, a little spike there in 2020. I remember when that happened. It was a little issue in the banking issue. They needed some liquidity, or they had too much liquidity. Something happened and they had to just park the money. Oh, look, that was right when the COVID disaster happened. And the banks were parking their money. Not a lot though. Quarter trillion. Quarter trillion is the high watermark there. In terms of something normal that you'd expect. Now let's take a look recently. You're at 800 billion to $1 trillion. I want you to think about that. The banks have money. Actually, the banks have collateral. No, in this case, banks have money. They park it at the Fed, $1 trillion overnight. You'd think if the stock market was good, or maybe there was some shovel-ready projects for infrastructure, they'd be lending the money out to contractors, builders, factories, whatever. .com, something, right? Hey, lend the money. Chicago Quantum, right? But we don't need the money. No one needs the money. So you know what? They're going to park it at the Fed. They're going to earn like 5 basis points. In fact, I heard that the number went up so much it was like 12 basis points because of some issue. But we're not talking a lot of money here, and it's overnight. It's very short term. So money's being sucked out of the economy, held with the Fed every night because there's nothing to do with it. $1 trillion, big number. What else I got here? Just to remind you where we are with interest rates. So when this yield is up, then that means the price of bonds is down. And when the yield drops, it means the price of bonds goes up. So basically the price of bonds since about end of March, early April, bonds have appreciated, which I love because I have money in bonds and like bond funds, like in a 401k. They're going up. Bonds are going up. It's great. You're not getting a lot of interest, but the capital gains on your bonds is great. So bonds are a little more expensive now. So if I need bonds, if I need collateral, if I need assets, they're more expensive. So this is the weirdest thing because we're borrowing $3 trillion this year in deficit spending. But yet the interest rate for 10-year money is 1.18. By the way, not that they're listening, but Chairman Powell, this would be the Treasury head. This is not the Fed head. So the Treasury head, a name escapes me. The next $3 trillion that you got to borrow, why don't you issue some 10 years? Sure, it would be nice to be paying 1.18% interest and then taxing it at the federal level. So you're picking up like 30% of that back. So your total cost of the debt is like under 1%. Love it. Do it. But what this tells me, right, there's another message here. When's the last time they were so low? COVID crash, 0.5 point. August of the COVID crash, 0.5 point. So the point is, when these long-term interest rates are dropping, to me, my sense is it's a flight to safety, a flight to quality. People are selling their mutual funds, even in a 401k, or big investors, institutions, trust companies, you name it, holding companies. They're selling their assets and they're putting them into the safest thing around. Reserve currency, notes, and bonds. 2 to 10 year and over 10 year. So there you have it. It's a safety play. And so what I would argue is we're seeing people find money, where'd it come from? And either stick it in the bank, and then the bank has $1 trillion extra, or stick it in treasuries. Treasuries have extra, look at that. The yield's gone from like 1.75 to 1.18. A lot of money. I just want you to think about it. Money's got nowhere to go. Let's go in safety. This was a little note in Reuters. So Monday there was a funding pressure. And the repo rate interest, like I said, was 12 basis points. It's the cost of borrowing short-term cash using treasuries or other debt securities as collateral. Normally, it's 5 or 6 basis points. Fine, so now you got some pressure in the banking industry. Okay, I don't want to hear that. I don't want to hear that banks don't have the money. It's not nice. It's not a good feeling. I want the banks to have tons of money. Maybe some banks don't have money and others do, but I want to hear that all the banks are safe. FDIC insurance is it's quite challenging when you got to pick that up. So that's interesting too. So now let's take a look at the stock market map. You know, I love this chart. Let's look at it for the week. Where are we for the week? First off, where are we for the month? For the month, consumer cyclicals are down, which is interesting. Energy is red, blood red. Diversified banks are generally red. Airlines are red. So the economy is not popping back, right? Airlines are down, shipping is down, energy is down, lodging is down, travel's down. So people are betting against the economy reopening, which is interesting. So I'm going away with the fam to Alaska next week. We're spending a ton of money, right? Because you got to fly there, you got to stay in hotels, got to rent a car, got to eat, got to do things, right? We're going to be visiting the highest mountain in the United States, Mount McKinley, which is now Mount Denali. It's great, right? But with the COVID numbers, it's probably our last trip of the year. Probably. So things are down. Look at Uber. Uber's down 17.25%. Now, honestly, that's more transportation. I bet Lyft is in there somewhere. Lyft is probably down too. So things are down. Even Budweiser's down, which is unbelievable. Budweiser's down. I love Budweiser. Sam Adams, Boston Beer Company's down. So people aren't even drinking right now. It's a tough economy. So now let's look at it for the day. How are we doing today, Mr. Cohen? Well, oil and gas is down, right? So my guess is that if I were to look at oil and gas prices are up. It's going to get cold. People are going to be home. Going to be using gas. But oil's down. And so this is not a trend I would want to be playing around with. And you can see aerospace, it's just a lot of red right here. The whole consumer defensive. Consumer defensive is red. Real estate's red. Utilities are red. Your basic materials is red. Your industrials are red. Energy's red. I don't know, there's a lot of red out there. So it's not a great time in the market. But then again, it could be summer. It could be the volume in the summer. I get it. Volume in the summer. If we look at the main page, you can see a fair bit of movement. But in general, the S&P 500 is it's topped. It's not moving too much. I'm just looking to see if anything interesting here in the stocks that we follow. There's some crazy movement, but here's one I wanted to talk about. Aero City. They lease aircraft. When you look at the stock price, you think, wow, this company must be doing great. I want to, find out more about ACY. No, you don't. ACY has been in bankruptcy by about mid-August. They're going to have a final settlement. Either it's a tear up or a sponsor came in and bought the company, which is now basically just a shell. Probably worth $1, maybe $2 a share. $25 a share right now. So I want you to think about ACY. I want you to look at it, right? ACY is a pump. It's a total pump. I want you to think about it. It's a pump. It's in bankruptcy. There's really nothing behind it. And yet it's up to $25 a share. So you're still seeing activity like this in our market. Just want you to think about it. Oh, I missed this with the Fed. How are we doing with assets? The Fed holds paper, holds debt. And what you see is right here during the crash, during the pandemic, March 4th, 4.2 trillion. June 10th, 7.2 trillion. So they picked up $3 trillion worth of assets and they put cash or reserves into the economy. $3 trillion. Where do you think all the money came from that I showed you before? Right? And we're talking about an economy, maybe 22 trillion cash, about 22 trillion. When you add 3 trillion, that's 13, 14% of your economy, of your money supply, where the Fed took pieces of paper. Well, look, I'll take your pieces of paper and I'll give you $3 trillion for them. Three. You hear that? $3 trillion I'll give you. You give me the paper. So why do you think collateral is so hard to find right now? Because we bought $3 trillion worth of debt, probably mostly mortgage-backed, mostly Treasury and some mortgage-backed, maybe some agency paper, maybe Ginnie Mae, maybe Freddie Mac. I'm not sure, but I know a lot of the mortgage-backed Treasury. So we're running a fiscal deficit. We're buying back the paper, right? So we got all this paper, right? Who knows what it's worth? It doesn't even matter. They gave out $3 trillion, right? So now, what just happened? By the way, if nothing happened, there would be no reason to talk to you about this. Something happened, okay? So what happened is, from July 21st, July 14th to July 21st, we grew by 40. From June 23rd remember this number, 8.1 trill to 8.24 trill. So $130 billion in assets. I would argue that this is a slowing of growth. We're seeing a slowing of growth in the paper. Now, there's still just, like we talked about, $120 billion a month. So from June 23rd, 8.1, July 21st, 8.24. So they haven't started the taper yet. But there's no extra buying going on. And so what this does, this puts cash back in the economy. So the government didn't create any cash. The government is still pumping $120 billion a month into the market. So if they pumped $120 billion into the market, but the market cash didn't grow, it means the market destroyed $120 billion worth of money. Where'd it go? Where'd it go? Yeah, we talked about the federal repo rate. So, I guess last but not least, right? So some people were asking me, Jeff, is this an issue of maybe one type of debt? So this is Department of the Treasury. I figured it'd be a nice reputable site to use. And the Department of the Treasury, from yesterday to today, 30-year money yields went down, 20 went down, 10-year went down, 7-year went down, 5-year went down, 3, 2, 1, 0 all stayed the same. So basically anything 5 years and up went down. Now let's see if I can find 2021. Go. And what I'm going to find there is the yields actually dropped maybe a bit more over the past, Yeah, what's interesting is July 19, they dropped for a day. So July 19 must have been some kind of an event. But these long yields, the bonds were up over 2%. Now we're at 1.85. So you've got a relatively recent weakening. You had a weird day. Just think about it for July 19. So rates are down. Yield curve is flattening. If the short yields start to go up because there's a shortage of money, I actually heard someone on Twitter say that. Shortage of money, short rates go up, we could have a flat yield curve to an inverted yield curve. We're not there yet, but we're flattening out the yield curve. I think that's important to look at. I love having all this data. You can see I'm bookmarking. Market value of government debt. I'm just going to save that. That's not worth it. But when you look at the amount of debt, you shouldn't always look just at par value. You should look at the market value of the debt. It's a better thing. So Bitcoin, always interesting. If the market's bleeding, right, Bitcoin shouldn't be doing that well. But in fact, what you see here is Bitcoin is as volatile and as heavy as ever. Look at that. Nice little peak, and it's starting to come back up again. So we haven't seen the end of crypto or Bitcoin. This is very exciting stuff. And that means all the stocks and all the advisory services and all the miners, those stocks, every time this thing pops up 10%, it's like a boom town, right? Bitcoin drives some economic activity. And yeah, look at that. Up 3.7%. And, up $1,400. So this is just, instant volatility for those who like to invest in volatility. We talked about ACY. So now I'm going to switch over. Let me check the list. Where are we at? And if there's any other data. Oh, let's take one last look. Yeah, we're good. So now we're going to switch to COVID. The COVID. Where are we at with COVID? So the first thing is, you're going on vacation, so you want to look in the United States. The United States level of community transmission is the highest level. 7 to 8% positivity in the United States. So that's when you take a test because you got a cold or some cold symptoms. So you go take a test. It's 9.6%. That number was 5% not long ago. We've doubled the positivity rate. Okay. Let's take a look at percent positive. Here it gets interesting, right? Illinois is still 5 to 8. Oklahoma's high, 20 to 25% positivity. Maybe only the really sick people can get in a car and drive. I don't know, but some different numbers. And gray means no data. Let's look at last 7 days because that's really what's important. So you're looking at the South. Mississippi, Alabama, Oklahoma, Nevada, looking tough. Thankfully, we're going to Alaska. It's only 5 to 8%, which is the same as Illinois, so it's not worse. But this level of community transmission has me worried because it means things are starting to spread, right? Got that. Now let's look at the chart we use. We go to Google. And Google says it's from the New York Times. Honestly, I don't know. I don't know if this is the right data or not. But what I like to look at, we'll start with Illinois, all counties, and we'll look at it for a month. And this is a chart that really spoke to me. So if you go back to July 9th, this is Monday. So what happens is, like just after a weekend, a busy weekend, they kind of catch up, right? Saturday is like 0, Sunday is 0, and then Monday is like a 3-day. So it's a nice little aggregation, right? So Monday at 1100. Remember the numbers, 1.1. The next week, 1.5. Not bad. The next week, 2.6. It's growing. Next week, 4.1. This week, 5.3. So from 1.1 to 5.3, what is that? That's pretty fast growth. That's all I'm going to say, right? So the growth, the cases are up. And if we look at it for all time, growth isn't everything, right? But if you look at the peak we had in the spring was 3,500 cases. We beat that on Monday. We beat it last week, Monday. All right, so where do we got to go here to get big? To get big, you got to be in January through October. So during that peak. So when everyone was crazy and the governor's crying and we're shutting the whole state down, and we're almost back. Okay, we're almost back. Just want you to think about that. I'm not going to look at deaths. That's a little morose. But now let's take a look at the whole United States. Illinois, it's just Illinois, right? So let's take a look. Again, I don't want to look at all time. So let's just look at the weekly, the last 30 days. So here it's not as simple, right? So here you kind of have to look at this 7-day average. Because across the U.S., there is some weekend diagnosis here. So we're at 18,400. The next week, we're at 27,000. So 18, 27, 35, 56, 85. We're up to 90. So from under 20 to 90 in 30 days. That's about the same percentages as Illinois. And if we go back, how's the peak looking? Well, we're here. We're at 150,000 new cases yesterday. 150,000 new cases yesterday. Well, you were at 75 in the spring. I mean, forget it. Forget about it, right? You have to get to January 29, November. So November to January. So we're right back in the peak. This is shutting the whole thing down. The president, all those issues. I think the president got COVID at that time, right? So now we're starting to approach those levels, and I don't hear much. Now, I hear it on the inside, meaning some inside information coming in about companies having to cancel in-person meetings, in-person trainings, things like that. I'm hearing. But in general, right, like I went to the library yesterday to study. I had to wear a mask all day. Stinks. I had to wear a mask all day in the library. Couldn't take it off. I drank water, I took it off, put it right back on. You can't go in a government building in Highland Park, where I live, without wearing a mask. It's too bad. We're going to buy some more masks, right? So, I think COVID's here to stay, guys. I think it's coming back. It's coming back with a vengeance. And so what does that mean? It means things are going to start to shut down. A lot. A lot of shutdown. And I don't think the market's pricing that in. Now, I want to share something else. This is just for fun. So one of the things I do is I look at what stocks are up intraday, 9% or more, and what stocks are down intraday, 9% or more. And when I looked at this earlier today, the numbers were different. So in fact, it was like a different analysis, right? So let's take a look. Really up intraday. Really down intraday. And so when I look at up, one of the things I look at, I see a lot of biotech up. Pharma, life sciences, therapeutics, biotech, they make vaccines, therapeutics, biosystems, health. So there's a lot of this. So like you see, how many of these are there? These searches are made to be, so 61, they're made to be roughly equal, right? So I see a lot of biotech. It's very interesting, right? So biotech's doing terrible right now. But individual biotech stocks, very speculative, micro cap, looking good, or even small cap. Let's take a look at the downers. Where are we? We're at 87. So it's about the same. So you see this like interesting dichotomy in the market. Winners, losers. So we run two models. We run an all-stars and a dog stars. And we just recently published in Medium the result of our dog stars that we picked in mid-July. They're dogs. We picked them. If you would have invested in all 20, shorted them, all 20, you'd have made a ton of money. We created about 11% alpha in 15 trading days. The funny part is it's not even that expensive. You could buy a run from us. It lasts for 25 days. It's anywhere from $500 to $1,000. And then you get the list. And then you can earn yourself, a research list. Right? You got to do your own research. But let's take a look at the downers. Gen, I'm guessing that's biotech. ZY, a therapeutics company, a pharmaceutical company. Not as much, though. Avis Budget. Penn, Virginia, right? That's the coal company. Some other pharma. Not as heavily pharma. Oncology, Intech Pharma. All right, a little bit of energy. I thought I saw Callan, Petro. A little bit of energy in there. Not so much. Yeah, Lyft. Remember I talked about Lyft? I couldn't find it. It's down to almost 10% today, 9.5%. So it's just interesting. Lots of dogs. Laredo Petroleum is down. So that's an E&P, low leverage E&P. So the market is up and down. What's interesting is the S&P is down 0.3. The Russell's down 1.2%. Dow's down. Nasdaq's up a little. Crude is down. This one I got another chart for you, but I just want to pop it up. Crude is a bet on the economy, right? The demand. So, of course, when things were going wrong in March of last year, the price of oil dropped. Forget the one-day thing. You were at like $20 a barrel. And we've climbed. We've climbed the mountaintop. We got to 75. Now we're down to 68. We're still pretty high on oil. But it looks weaker. And in fact, if you look at the volume, you're not going to be able to see it unless I really zoom on in here. But you see low volume. You see distribution days. Low volume, high volume distribution right now, which is a little bit scary for energy. So I don't mind if it's low volume distribution because it just means a lack of commitment. But when you see a drop and it's reinforced by very high volume, I don't like that. That makes me nervous. So pharma's looking good, but in general, pharma's dog meat. Oil's looking really bad. The markets are very mixed. Where's the VIX? Where's the VIX? Why aren't they showing it? Yeah, they're not showing it right now. Must not be doing so hot. The fear index. How's the fear index? That's like 18. It's not much. Really peaked. Oh! July 19th. Remember I told you when treasuries fell to the floor? Flight to quality? Well, the VIX jumped to 22.5. So the VIX was up 20% during a flight to quality. So people got nervous. Now it's back again. I'm trying to tie your attention to the fact that there is a rushing for the exits happening. And if you haven't taken some chips off the table, think about taking some chips off the table. What I mean is think about lessening your exposure to equities. Just think about it. Please think about it. I'm still recording, right? Yeah, it's 36 minutes in. By the way, if you got a question, ask a question. I'll post it in the chat. AMA. Ask me anything. That's why I'm here. Not just to hear myself talk, although it might sound that way. My wife says I talk all the time and probably should stop. But VIX is up. Interest rates drop because people are just flooding treasuries. Flooding money into treasuries. Which could be why the yields are lower. Because they're flooding in. It's not that the treasury, the paper is short. So people want to buy the paper. What else I got here? So I'm going to talk about the three stocks. Truthfully, they're making me cry a lot. These three stocks make me cry a lot. Why am I in them? Why am I in them? Satsuma, Akebia, Corbis, and let's take a look at the ETF for biotech. It doesn't invest in particularly in these three, but it's a nice thing to look at. So if we look at XBI, go all the way back to March. So biotech looked good. It peaked up there in February. And since February, it's been a relentless decline. It's trying to hold its own now from about May to July, but this is not a really good place to be. Biotech does not have a lot of investment in it right now. It is not a great place. So then you have Satsuma. One of the things I love about Satsuma, if I can be honest, is from a fundamental analysis. So when you look at the chart, you should be scared, right? So this thing dropped from $23. It's now like $5. So first off, not good, right? Not good to catch a falling knife. But it recovered from like 450 to 720, 718 to 480 to 7.25, back down to 498. So why does the stock keep bouncing off the ground? Well, because it's got a lot of cash. This stock has a lot of cash in the bank. They have enough money to keep doing their work for a very long time. I'm just going to look at the balance sheet quarterly. How much cash they got? They got $133 million. They got like no debt, $2.5 million. They got $133 million in cash. They even prepaid $3 million in expenses. Probably like, just rounding up a check, like if you pay your ComEd bill, your electricity bill. Sometimes you round up. I do that. If it's 130, I might give them 200. That way next month it's a little cheaper. So $133 million. Well, what's the market cap? 160, 161. So it's not a big bet here. It's 133 million in a bank, plus a couple million prepaid. That equals all your total debt. It's 161. So you're basically getting a migraine headache possible cure for, what is that? 28 million bucks. That's good. I'd pay 28 million bucks for a potential cure for migraines. You probably make that much selling it in Chicago. We have these headache clinics. They get a lot of people in them. You got a headache cure, and by the way it works, it's like Flonase. You take a little container. I used to have a good one here, but just go 3 times in 2 hours. Your headache's gone. It's not a headache; it's a migraine. It's gone. No pain. Now it doesn't always work, but it's safe and it's highly effective. And so, they're working through a new phase 3 trial. I love it. I just keep wondering why it keeps falling. Why does it go up to $7 and then come down? Well, I guess he's got to be patient. I'm patient. So I bought more this week. AKBA. Now, AKBA is interesting. AKBA also fell to the floor. I mean, I hate to use bad language, but I really want to right now, right? AKBA is a heartbreak. It's like the Chicago Cubs when I first moved to Chicago. So why am I wearing a White Sox shirt? So I started following the White Sox. They weren't a very good team. They're a great team. I love watching them. The games are exciting. They've now got some pretty good pitching. They got pretty good hitting. But in general, the team comes together. It really performs. What would happen with the Cubs was I'd go to a game, they'd be up by 6 runs, and then Andre Dawson would have an error, and something would happen, and they'd lose the game. Every time I went, the Cubs clutched defeat from the jaws of victory. And that's the story of AKBA. The story of AKBA is, thing goes up, $5, drops all the way down. So we called it, our model called it right here around $3. It pops to 420. I hope all the paper hands got out, because we didn't. We rode this thing all the way down. So imagine 420 to 247. That hurts. We just bought some more last week. Gluttons for punishment, I guess. But it's a great company. It's a great company. They're investing in kidney cures. They have one drug right now. They have a second one where they've made the NDA into the FDA. They got about 10, 11 months till the FDA has to rule on the new drug. If they get the new drug, it's a lot of money. The stock's going to go up, I think, because the new drug alone is worth a lot of money in profit. And they're hiring like crazy. They're doing inducement grants. So here's the thing I don't understand about a company. I'm going to go back to the news on AKBA. Not the fancy news, but the news you might get if you clicked on Yahoo Finance. So let's take a look. So, and by the way, they also got a lot of cash. They're sitting on a lot of cash. They're all right. They're a good company. But they're hiring a ton of people. So let's just take a look. So let's look at news. So the first news is, that's fine. Here. They may report negative news. Okay? Reflecting on the share price, which is nothing. Some other company just got AKBA to pay them $18 million. AKBA is picking up, I can't pronounce it. It's a drug. I looked it up. It's not quite there. It's got a lot of work to do. It's got some development work, some research to do. It's not like it's phase 3 and ready to go to market, but it's a nice type of drug that fits into your kidney type medicines. And then I want to look at the press releases. So they have inducement grants. So they're giving 100,000 shares, which vest, I want to say 3 or 5 years to like 14 employees. And then there's a lawsuit going after them Lawsuit going after them. They're going to issue results. There's nothing here. There's inducement grants and there's presentations and there's a bunch of nothing. So there's no news. There's no news. But the stock is relentlessly falling. So either they're going to dilute, they're going to have terrible earnings, they're going out of business, but I don't get it. They're hiring like crazy. You go to AKBA's job boards, so they just hired like 50 people. AKBA jobs. Home office non-sales. Let's look at their sales. Okay. Jobs. Syracuse, Denver, Memphis, Oklahoma City, Winston-Salem. So here's a question for you guys. If you don't think your new drug is going to get approved in the United States, why would you be hiring all these employees to sell in the United States? You wouldn't. So management has reason to believe that this thing is going through, or they're just betting the bank. They're betting a company on it. So I'm all right with that. That 250 is going to be dirt cheap. Now let's look at Corbis. So Corbis is a little tougher, a little more early stage. This one also fell off a cliff. Boom. 9.25 to $1.30, $1.88. It's been up, it's been down. It's been up almost to $3. It's been up and down. You know, it touches $2, it comes down. This thing's been on a relentless decline from about $2.20 to $1.30. Let's look at the news here. Oh, it may report negative earnings as well. Thanks, Zach. I'm really glad that you're jumping on it. They don't really have revenue. They just have cost. They have phase studies, drug trials, research. Lenabasum. This is when you get chronic inflammation and your muscles weaken, atrophy, or you get these horrendous rashes all over your body. They're like it's like a bow tie on your face. It's awful, right? It's hard. It's hard life when you have this disfiguring illnesses, where your muscles stop working and now you can't even lift things. You have to sit down. You can't walk the stairs. Okay, so we're trying to fix that. The medicine's safe. It didn't do everything it was supposed to. It did some. It did a lot, but not everything. So now they got to work with the FDA to figure out how to move forward. It's a really important thing to cure. And so they've got a nice pipeline of drugs. A little earlier, they're looking at cancer, immunity deficient people, and inflammation, fibrosis. So I think they've got cash. They've got a drug pipeline. They talked about diluting, so they've now authorized double the shares. You know they're going to dilute. You know it, but you can't dilute at $1.32, can you? It's awful. I mean, maybe you do. So let's look at the financials. Balance sheet. Quarterly. Now, they just reported, so there's going to be new data, but let's just look. It's good enough for government. Current assets, $124 million. Prepaid, another 3.6. So figure the prepaid. Let's see what their liabilities are. They got debt at $25 million. So cash, 125 minus debt, 25. So let's say they got $100 million in cash, free cash. They could go $100 million. So what's the company worth? 165. So you're paying $65 million for a great pipeline of cancer fighters and all these other stuff. So it's not bad, but there's no love for the stock right now. There's no. I mean, it's touching long-term support levels here, and so you either believe or you don't. You either believe or you don't. Now, one thing I will tell you is the calls are very expensive on this stock. It's going to cost you like 50 cents for a reasonable call. 30 cents, 17 cents, 50 cents, $1. I mean, it's crazy. The implied volatility on this stock is through the roof. And so you can't really afford to buy calls. So what does that mean? I don't understand, Jeff. So what it means is the price is low, but you can't really lever up. The only way you're going to bet on this stock is you're going to buy the common. So we just increased our position by 1/3 today at these low prices. I like the stock, and I like it at this price. For me, it is highly speculative, though. It's not a blanket recommendation. Highly speculative. I mean, you might as well take your money and burn it. Maybe get a little warm, right? You know, that's it. But I like it. And I like it enough that I put some more money, fresh money in. And so, where are we? If we look at Satsuma, I want to walk you through the logic here. So Satsuma, it's up and down. I think it's going to follow the same cyclical pattern. You got a floor based on cash. You're doing all right. Risky, pogo stick. Up and down, up and down. Let's hope they get some news. Corbis, relentless dog. Just a dog with no support. It's also got a floor with cash. It's got a nice drug pipeline. I like it. AKBA. This one I'm not sure. I think it's a relentless short. Shorts. The shorts are just pounding this thing to the ground. Pounding it. Volume's low. We're into August, summer months. And so in my opinion, for me, you're picking up a steal here. This could be a 3-bagger. You could be looking at $10 a share. In my opinion, it's a $10 stock. But that's not advice. It just is what it is. And I like it. I like it a lot. I bought more last week. This one's nice. And I bought some options too, some calls. So what else we got? Just overall stock market. I'm going to stay focused here on the S&P 500. And the reason I'm going to do that, it's a good index. Let's pop it up full screen. I could bounce things off of it. By the way, I'm going to show you some other things here. Where's my volume? Volume chart. So the first thing I want to show you is the S&P's up, up, up. Love it, right? I'm going to clear the drawings. Up, up, up. This thing's beautiful, right? But you could see there's a little bit of a top here, right? A little bit. Let's zoom in. And let's take a look at the volume. So the volumes are down a bit in August. Now you could say, look, Jeff, it's the summer, people on vacation. That's fine. Volume's down. But when I look at this, I suddenly see let's do a trend line. I see flat. Now, it's going up from here. But let's even look at it over here. It's flat. So, question is, low volume, flat, S&P. I don't know. Not feeling it. So let's add. Let's add the Russell 2000 ETF. It's looking pretty similar, except it's not quite as good. And so what I would say is big cap, small cap. You might be looking at a top here. It's just over a couple of weeks, maybe a month. Yeah, we're looking like 3 weeks. So let's blow it up a little. Here we go. Let's take it a month. Yeah, volume's down. Stocks are down. This is what it is. So let's make the big prediction. What is my big prediction? So we've seen tightening in money supply. Yields are low, flight to quality. Money is sitting idle. Doesn't know where to go. Oil's down. Core economy's down. COVID cases are up. I think we're at the top right here. S&P, top. What level are we at? 44.22. $44.23. See if I can pop that up. That's the prediction. We're going to make that bigger for you. Doesn't mean some stocks won't go up and some stocks won't go down. It doesn't mean there's not an ability to trade. But what this tells me is we're at the top for now. Take some chips off the table. All right, I want to thank you very much for watching. By way of a public service announcement, this is Chicago Quantum. I am Jeffrey Cohen. We are a consultancy based in Highland Park, Illinois. We are going through our process to become registered, certified investment advisors, both with the feds and in Illinois. That has a lot of process and a lot of details, a lot of studying, but that's great. We love it. Here's how to reach us. Here's the research we did. You could buy a stock analysis. You could buy longs. So if you want to know what we think is a good place to put your money, or you could ask for a short. What's going down? What's going down fast and hard? For $7,500, we'll do some coding for you per week. And we'll give you the code. I don't know how long it'll take. There's no guarantees, but you can buy time. For $100, if you already bought a run, for a half hour, we'll dig deep into the analysis for you. You could also buy a project. $250 an hour, $2,000 a day, $5,000 a week. You get a workshop. You get a lot of management consulting. We publish a lot of data about the market. We publish return data. We publish where to find free data. That's what all this is. These are all links. Free stock market news. And then there were questions that we had before we started studying the 65. This was earlier. All kinds of stock market questions. Remember there was a gamma squeeze thing? We had a whole thing on that. What's beta? What's swing trading? Bonds. Talk about bonds. Talk about front running a trade. Average true range. Then we talk about skewness and kurtosis, which are third and fourth order movements of a stock. Just lots of things. And then we also publish data. Oh, come on, where is it? Hang on. There it is. We publish negative beta stocks. I always say Chicago Quantum, home of the negative beta stock list. This is a list through July 27. These are all your negative beta stocks. People like to invest in negative beta stocks, or like to understand them. We also publish a full list of stock splits. We're not sure why people prefer to know about stock splits, but it's good to know. Anything above a 1 is a stock split where they give you more shares. Anything under 1 is a reverse split where they take shares away. 100 to 1. 100 to 1 reverse stock split. Okay, it's interesting. It's good to know, right? We also publish a list of all the stocks that paid 10% or more stock yields this year based on the average closing price. So it's not current yield, it's the whole year compared to the average for the whole year. You see a bunch of stocks in there. Some of them paid as over 40% dividend yields. 30s, most of them they're in that kind of 10 to 20 range. But 10 to 20% dividends or distributions is pretty nice. For those who like dividends, for those who want a company that's got the cash and got the power to pay these off, you want to take a look at those. I know people that like this list because they use it to then do their research to find high yield dividend paying stocks. Plus, for those quant heads out there, we got a list of validated tickers. This was July 23rd. So if you like to play around with stocks and Python and data, you can take this list. It's a pretty clean list, and put it into your Python. Rock and roll. That was one of the hardest things for us to figure out at first was how do I get the tickers? I remember people saying to me, Jeff, I don't know all the tickers, right? What do I know? 5 tickers. IBM, X for United States Steel. Give me some tickers, right? And so now I'm giving you 3,632 tickers. Pretty much all the stocks you like are in there. So dig in. And there's much more, much, much more. You can buy a run. You can see all the different stuff we do. And last but not least, you can buy a t-shirt. You want to support us? You buy a t-shirt. You can buy 10 t-shirts. I don't care. They're $10. If you want to buy the t-shirt and then not even get the t-shirt, let me know. But I ship you a t-shirt. It's awesome. So whatever you can do, this is how we make money. This is our full-time job, right? And I'm looking to get an office in Highland Park and fill it with employees. So to the extent that people buy runs or ask us for investment advice or ask us just to run quant models for them, we'd love to do that. And again, I want to thank you very much. I hope this was beneficial for you. Going back to the prediction, I predict the S&P is at the top, the closing price. Not to say during the day it won't pop up, but closing price 44.23 until at least October, November. So my suggestion is take some chips off the table and have your powder dry. I want to thank you very much. You take care now.